Hey guys, John Polemy here with another update. Basically, I wanted to talk about a phenomenon that I think is showing me that we are at extreme levels of overvaluation. Now, I've talked about this before. My strategy, or one of my main strategies, is to sell overvaluation and buy undervaluation. And right now, with the US stock markets at all-time record overvaluation metrics are in place, let's put it that way. So this is a Wall Street term that is used, that they say on Wall Street, a lot of the old-time stockbrokers, stock people, when the ducks quack, feed them. And what that means is when there's a demand for stock or IPOs or something is hot, like a hot industry, like recently in the last year with electric vehicles, for example, you notice that all these companies were going public. Some of them were, not even viable companies like Nikola. But that's what they do, right? There's a demand for stock, so they sell stock, they sell stories, and retail sucks it up. Something you need to remember, if you didn't already know, you should know, is that Wall Street is in the business of selling stock. They're not really, could care less if you as an investor makes money or not. The objective is to sell stock, get assets under management, and then cream various fees off. That's basically what they exist to do. And so like I said, when a hot sector comes along, you see this a lot in the resource sector. When a sector gets hot, you will see a whole bunch of share issuances come along. And this is usually an indication of you're near the top. One of the stories I like to tell is about the previous bull market in uranium stocks. And before, at the top of the market, or at the start of the bull market, or before anybody really cared about uranium, there were like 2 or 3 publicly traded uranium stocks, because there really wasn't more than 2 or 3 viable uranium companies. But after 4 or 5 years of a bull market that saw the uranium price get up to like $120, $130 a pound, there were close to 400 to 500 publicly traded uranium companies. And that's an example of, if there's a demand for uranium and uranium stocks, then the brokerage firms in Vancouver and Toronto were turning them out left and right. So this is from an article by GMO, that's Jeremy Grantham Shop. And I just wanted to point this out because this is kind of an indicator that we're probably near a top, or we're getting near the end of this over exuberance that we're in. And basically, stock issuance is the highest ever, as firms and Wall Street know when it's time to sell to eager buyers. And so you see here, this is the tech bubble. You see that at the top of these are the IPOs, were close to $150 billion. And you can see now that we're exceeding that. We're like, almost twice that. Now, the argument will be made that that the market cap of the total market is a lot bigger. I will grant you that, but this still is not a good sign in my book. This is an indication that there's a lot of demand for stock, a lot of demand for stories, technology, ESG, renewables, electric vehicles, batteries, the whole shebang. All of that's very popular now, tech stocks, and everybody's looking for the next Amazon or Tesla, something like that. So there's a lot of stories being told. The SPAC bubble looks like it has already burst. And so this is just something I wanted to point out. This is an indication when you see this that you should be wary of the, this is just another alarm bell among the other, double-digit amount of various overvaluation signals that we're getting about this market. So, I don't know what's going to prick the bubble. Maybe it's something as simple as the upcoming Jackson Hole Fed meeting, or the beginning of the discussions around tapering bond purchases. That may be enough to get at least a significant pullback in the market. So you can't know the future. I can't know exactly when or what will prick this bubble that we're in. It may go on for some period of time. I look at like CAPE ratios, the cyclically adjusted PE ratio, and it's, in the high 30s right now. But in Japan, and during its bubble in the early 80s, it got to a cyclically adjusted PE of 100. So just because something's overvalued doesn't necessarily mean it can't get more overvalued. But why play that game? Why play the game of, having like a 10-year bull market since or longer, since the great financial crisis, since the S&P was at 666? We've had quite a bit of a run, and, look at what this is basically levitating on, with all the discussion around what the Federal Reserve is going to do and what the fiscal policy of the U.S. government is going to be. And I just think there's a lot of potential potholes in the road coming up. And I'd rather go buy things that are undervalued. I'd rather go buy something that no one talks about, is undervalued, but yet has prospects for turning around. And we find that even in the U.S. market with a lot of the resource stocks that we're involved with, like coal and some of the other things. But I would like to point out a couple of other things, slides, while I've got your attention. This is the emerging markets are cheap relative to the overvalued U.S. stock market. And so what you see here is the relative value of emerging markets versus the S&P. And you'll note that right now, emerging markets are at about 20-year low relative to the S&P. And you will note that these things go in about 10-year cycles, right? When emerging markets become undervalued, the S&P is typically overvalued, and then you see a mean reversion. And then we got to a point where the S&P was relatively cheap during the great financial crisis, which you can see here. And then emerging markets were relatively expensive to the S&P. It was time to reverse it. So what I'm saying is these trends go in about 10-year cycles. And it looks like we're at a period like back here where emerging markets are relatively cheap with respect to the S&P. That doesn't necessarily mean that they'll outperform, but if you look at a lot of the markets that I'm looking at, or things that I've talked about in the newsletter, some of the places where I'm looking to put money or have put money, they are relatively cheap. I'm not paying high 30 times earnings. Now, granted, these places that I'm talking about don't necessarily seem to have the same prospects. They don't have the same technological innovation and these other things, but they're not, wastelands either, where nothing's happening. They're areas that in many cases have low debt. They have governments that are pursuing market positive changes. They, in many cases, have positive demographics where a large proportion of the population of the working age population is young, where in the West, and especially in the US, we have challenges with that. So these things can be cyclical or secular, and these are things that sometimes you only need to make a decision once every decade. So I would suggest to you that if you are in a situation where the market in the US is at historic valuation levels that in the past have indicated that it has a mean reversion to the downside, aren't you basically just picking up nickels in front of a steamroller and hoping you don't get run over? I'd rather go and put my money in areas that are historically undervalued and watch those mean revert. So that's kind of my thesis. The other thing I'd like to talk about is commodities are like super cheap. This is the CRB index relative to the S&P 500. And as you can see, I've taken this back to 1990. So you're talking 31 years, and we're at like record lows. So commodities are the cheapest they've been relative to stocks in 30 years. Now we've seen a big uptick. You see the big bug 19 crash, if you will. Maybe this was a capitulation move, but as you've seen, the CRB has been outperforming the S&P over the last couple of years. That doesn't necessarily mean it's going to revert all the way back up here, but you see, like, after the 2008 crash, you had this time when China, the last bull market in resources, you had a pretty decent move from here to here during that time. And that was still over like 13 years ago. So if you catch this right, and you can see where you can try to catch these trends when you see the 50-week cross the 200-week, that could be an indication to buy. That looks like it's been a pretty good indicator to catch the major moves. Same thing as it crosses below the 200-week, time to sell. So maybe that's the signal we use. That's the signal that we would use to get in and out of this. But I just think that commodities are relatively, and resources are relatively cheap as opposed to the stock markets of the world. So I don't know the future. I don't know what would make these things mean revert. I just suggest to you that, probabilities are that when you're buying, and not just probabilities, the historic narrative is when you're typically buying things that are expensive in the stock market, your forward returns are normally not that good. Now, the retort, the answer will be, well, what about Amazon? What about it? I'm talking about the market in general. And we've had historically low interest rates, which have levitated stock prices for many years. And, are we at the end of the 40-year bull market in bonds? Is our interest rates going to stay at zero forever? Difficult to say. So I don't see, if I had to bet money over the next 5 to 10 years, I'd say rates would probably be moving up, and forward returns on US stocks would have a tendency to probably underperform. That's just a guess. I could be wrong, but that's the probability. So I think when you look at emerging markets and commodities relative to the overvalued S&P, I like to sell, like I said, overvaluation and buy undervaluation. Emerging markets, many of the emerging markets that you look at are commodity based. They export some type of commodity, oil or iron ore, copper, who knows. These are large proportions of their earnings. So it stands to reason that when resources are performing, outperforming in a 5 to 10 year period during a secular bull market, that you would necessarily see the underlying, or the countries that are involved in that outperforming also. So just something to take a look at. As I said, this is really an indicator to me that, like I said, stock issuance, the highest ever, as firms and Wall Street know when it's time to sell to eager buyers. So just another warning sign for you out there. If you've got a lot of money in the general stock market of the U.S., you may want to consider what that means over the next 5 to 10 years. All right, that's it for this video. Talk to you next time. Thanks.